Okay, welcome back to Hurdle Rate. Today we're going to build the DCF for meta platforms. We've already done the WAC in the previous video. If you followed along, great, and you've got your spreadsheet up, awesome. If not, just use this just use this WAC figure of 10.53%. So without further ado, let's crack on. Okay, first things first, page layout, we take off the grid lines. We view, we freeze the first column, we insert another column in A, we make A very small, and we make B bigger. And in A1, we put meta. Let's zoom in a bit so we can all see this. There we go. Then we want to go data, stocks, and it will come up here. There we go. We put ticker, date, we want the current price, the implied, then whether there's any up or downside. Equals A1 ticker. The date today, I think, is the 29th. And the current price equals A1 price. Perfect. So the stock is currently $743. Yeah, so let's start building this out. Oh, come on. Assumptions, just put a little X here so we know it's the start of a new section. Assumptions, what do we want? Segment, switches. And what side is this? You have bear, base, and bull. Let's see how many. Okay, yeah, this is how we're going to separate the revenue segments. Advertising, other revenue, and that's the family of apps. And then we'll have the reality labs, which is, I mean, it's such a small, well, it's doing 2 billion in revenue, but it is tiny in comparison. So, sorry, I just bold these so that we know their headings. We want advertising, other, and then reality labs. Okay, sorry, 1 second. This is a free cash flow to the firm, so we'll use the operating income, not the net income. And obviously, that means we use a WACC. We don't use the cost of equity by itself. Okay, looking good. In the switches, no, we'll put it as 2. So leave it, when we're building it out, always leave it on the base case. Leave these 2 because these aren't switches. If this is your first time, I'll show you how to do those later. Right now, we don't have to worry about them. I think I go to K, don't I? Normally, let's do that just in case. Let's start, we'll do the revenue build now. Hopefully, because there's not many sections for the the revenue. Hopefully we can do this quite quickly. We've already done the cost of equity and the WACC, so yeah, let's yeah, perfect. Okay, we want to go here. We want to go to K because we're forecasting out to 2030. I'm going to just zoom back slightly so that we have 2030 in the frame. Okay, let's start building these. No, we can make B. What's happening? Sorry, my mouse is playing up. And I get it. Yeah, I shouldn't be using a mouse when using Excel. Sorry. Equals B10. Percentage growth. Bear, base, bull. I mean, percentage of growth, I mean, sorry, percentage of revenue really doesn't matter here because advertising is like 97% or something. B12. Yeah, okay, that looks good. Let's start filling this in. Number. Always use the 1000 separator and put your negative numbers in brackets. It just looks a lot neater. It's more aesthetically pleasing. So 113642, 131948, 16633. Okay, and to work out what the percentage growth is, we go on the so on the latest figure, on the later figure we go, well actually on the figure we go we select it and we divide it by the previous year and we subtract 1, and then we just put it into a percentage, and you just copy that over. Only do it to 2025 because we're going to forecast these ones out, and we're going to use a different method for that. And just copy your formatting down to here. Other, so this is 808, 1058, 1722. Just copy these down. Reality Labs 2159, 1896, 2146. And at the bottom, we just want to put a, yeah, got it. Just want to put a border. I guess the top line and go total revenue. Bold it, equals sum, and just select each of the revenue yeah, there we go. And always when you do this, when you're adding them up, just cross-check that they're coming out right. So I'll pull it across. So we want 116609, 134902, 164501. Perfect. And if you want to do your percentage of revenue, you just do it like this. And like that. Put it all the way across. Yeah, so Facebook overwhelmingly generates its revenue from advertising. So let's see how it's going to do in 2025. I think it was page 13. Here we are. Okay. So just the second half of the year, it's doing slightly better. 73965. So 2.1717. So wow, 19% revenue growth on an already huge amount of revenue already generated. Do the same here. 769. 2.23, so 1093. 2.2, let's call it 2.24. So the other's growing in quite, yeah, substantially. How we do this on the forecasting, I think we have to, we can't, obviously, we can't go with these growth rates, otherwise we will be insane. So I don't know, we'll put it so it goes to about, say, 10% in the final year, and do it that way rather than sticking with such a high growth. And then again, they might do it. We don't know. 2146 divided by 793. 2.7. 0.70617. Okay, looking good. Awesome. Wow, so it will do nearly, well, we projected to do 196 billion this year. Just copy these boxes. Okay, so this final year, let's say it trends to, I think it can still be going at 15% a year. G10. And for this, for the 2026, we're going to take an average of the last 3 years, 19%. Let's just format this so that we get it, it doesn't mess it up. 93%, 2 decimal places. Okay. Now we go equals, we take the previous year, subtract the previous year minus the final year, divided by the final year minus this year. And I always forget, but what we need to do is we need to lock in the column on this one. So yeah, this one we lock in the column. It just means that when we're copy and pasting it later, it's easier. But for the final year, we lock in both. Then we lock in the row here. Okay. This means that we should just be able to copy and paste it when we're going into the other revenue segments as well. And we won't have to do any well, we'll have to do minimal adjustments. And remember, for these, when you're doing your bare base and bull cases, put your own numbers in and see what comes out based on research you've done. I'm not really focusing on, say, looking at what, say, the analyst estimates are. I just want to show more the methodology of how it's done, and then you put in your own, well, whatever you think, because we'd all have a different opinion of how well we think this is going to do. But after every earnings report, it's good to update at least maybe twice a year to update, especially when we're dealing with, say, because the risk premium towards the end of the year is different to what it is at the start. So yeah, it's good to update and do it across your portfolio to make sure that, well, you know what's happening with it. You don't have to, panic sell or panic buy, but it's good to know what's happening. So what we do here is, because we want to use these switches, 1 is bear, 2 is base, and 3 is bull, we use this function called offset, and it just means that when we put it to percentage, when we toggle the switches, it can give us a different. It can move the revenue based on whether we're simulating a bull, base, or bear. I'll show you now. So okay, to forecast the revenue out, we take the previous year and multiply it by 1 plus the growth rate, and then just copy that along, and we have that now. So look at this, everyone. 227,157, 267,918. Just remember these figures, because now we're going to simulate a bear case. See, it goes down. That was 227. It's now 225. Then we can just put in a 3, and it goes up to 228. So yeah, this is very useful for doing for simulating different scenarios. Now, when we come here, there's a little bit of housekeeping we have to do. So this is saying 45. Well, let's trend this towards 10%, and it's going to be G11. And we need this to be E11. Copy it across. No, sorry, I did that wrong. It needs to be E. Lock it in. There we go. And this one needs to be I11. Just again, copy it across. And we can just copy it down, but we need to change C10 to C11 so that we have the right switch. And then just copy this down. You can put it all across straight away, and there we have it. So I mean, we're keeping this other at about 2% of total revenue. Well, actually, we'll see what it is once we've done the reality labs. But for the foreseeable, I do think it will be the advertising that is still the main driver for Facebook. For reality, I don't know, because remember they said that they wanted to start focusing so much because it was hemorrhaging cash. I don't know. Okay, let's put 5%. G12. One of my issues is I am overly pessimistic, so it so I always underestimate, which you're not being, I don't think you're necessarily being smart by underestimating. You want to try and be as accurate as possible. I've put it onto 2% here because I didn't want to have to deal with a negative number. That's more but it's, I mean, look, it's possible that the reality labs part does significantly better than, well, no, sorry, that has positive growth, not so significantly better. Let's, okay, copy this down, change this to C12, and copy it across. There we go, looking, yeah, that's it. Okay, that's our revenue build done now. So we're, okay, let's put in growth. There we go. So we're saying that Facebook, that we think it will continue to have double-digit revenue growth, but that will start to decline over the next 5 years, which, I mean, I don't think it's unreasonable to say, so we'll go with that. And remember, in the next 5 years, a company like Facebook, when you look at how much it's capital expenditures are on the NVIDIA chips and trying to go down that AI route, there will be other revenue streams coming up. It probably won't just be advertising. Maybe it goes into other, but it's possible there could be completely new revenue streams, which we have to take in mind as well. But I mean, we don't really have any insight into it, so we'll just go with what we're seeing at the moment. Let's go. So the next thing we're going to build is the income statement. And this is fairly straightforward. We just go revenue, and we put the revenue equal to here, and just pull it all along. There we go. And the next item is the EBIT. And the EBIT is the operating income, but it's pretty much the same. Occasionally there's things that differentiate the two, but for this purpose that's what we're going to refer it to as. So income from operations, that is your EBIT. And let's take the first one, 28944. There we go. 46751. 46751. 69380. This makes so much money. I mean, we don't need it, but look at the net income, 62 billion for 2024. It's insane. And we want the EBIT as a percentage of revenue. Look at that 42% margin. It's huge. Taxes, 5619. And we want that as a percentage of the EBIT. What's the next one? 5619. I can't see. There we go. 8330. 8303. Wow, look, it's going from 19, 18, 12%. Okay, let's look for the most recent. The EBIT is, okay, so if it did, let's do 69380 divided by 28655, 28665, sorry. So 2.42 equals 37997 multiplied by 2.42033728. Okay, that's nearly 92 billion in EBIT. And now let's see what the taxes are. $3,455, 2.4. So whatever number's here, 3935 multiplied by 2.40318,379. Again, look, it's I mean, even though it's paying more tax, its tax rate is getting lower. So for now, we're going to do another EBIT section later, but for now, just average the last 3 years and project that out going forward. So you go equals average the last 3 years, and then enter, and then you copy, and then just scroll to the right and take it to 2030. And now for the EBIT, you take the revenue and multiply it by the margin, and then just copy that over again. And go equal. Then for the taxes, you take the EBIT, multiply it by the tax rate, the percentage of EBIT, and pull it across. Perfect. Now it's going to get interesting because we're going to go onto the cash flow items. And right now, we know Meta are spending a ton of money on CapEx. So how we project this out will be very interesting. Percentage of revenue, percentage of CapEx. I mean, I think is it CapEx up like 35% of revenue? We'll see in a second. This is change in net working capital. And these three, once we have our earnings before interest but after tax, these three are then how we calculate the rest of the unlevered free cash flow. And when we get to that, I'll explain how it works. Here's the income statement, through the cash flow statement. Sometimes they put it towards the end of the report. Even if I looked at it earlier, though, I would have forgotten. Okay, yeah, this is what we want. So depreciation and amortization. If we look at this, so for the most recent year, 2024, it's 15 billion, 11 billion the previous year, just under 9 billion for 2022. But then look at the CapEx, purchases of property and equipment. This is the capital expenditures. 37 billion in 2024. 2023 was 27 billion, 31 billion the year before that. So this is huge, which is why it's let's start filling it out. I mean, this is going to have a huge, if we project it out at a similar rate, because remember when Zuckerberg said, I mean, he said he made up the number, but when he said 600 billion over the next however many years, I mean, it's a lot of money. It's really going to like be quite stressful on the cash flow, especially as the whole point of a tech is that they're capital light businesses. So maybe that's changing now when they're all building out data centers. Okay, and then the CapEx is 31186 27045 37256. Yeah, I mean, what is this going to be? 20 CapEx is 27% of revenue. It's phenomenal. I mean, historically, he has always spent big and perhaps overpaid, Zuckerberg, but it's by and large worked out when you look at things like the acquisitions of Instagram, of WhatsApp. They've generally, I mean, everyone's looked at them favorably now. Okay, change in net working capital. We just do the sum of these. Here, these line items, changes in assets and liabilities. We just go equals. We can go sum and say 231,162 minus 106, 210, 4,300, 886. We do the same again. Sum minus 2399 plus 559 minus 80 plus 51 plus 5081 plus 624. equals sum minus 1485 minus 698 minus 270 plus 373 plus 323 plus 2805. Okay, let's look for the latest. Down, here we go. So for divided by 7011, 2.21 equals 8242 multiplied by 2.2105. So it's staying roughly in line. And also we want to know what the depreciation and amortization is relative to the capex. There we have it. So purchases of property. Okay, let's quickly just see what last year divided by 14, 573, 2.556 equal, so 29,479. Oh, this is going to be insane. 0.25650861. 75 billion on capex this year. Wow. Look at that. Huge. Change in net working capital. Okay, this is going to equal sum 1466 plus 686 minus 242 minus 574 minus 3338 plus 1604. Okay, now forecasting this out, we'll do the average. And I think we just have to do it as what it's doing, because we know it's going to be increasing at least over the next 5 years. Because I think that they've been quite vocal about that. Do the same with the capex. And we just have this very high capex over the next however many years. If we sum this up over the next 5 years, look at that, just under 485 billion. Do we put it a bit more aggressive? No, let's leave it for that now, like that for now. Okay, looking good. Now now we're building the DCF. This next section is DCF, and it's very much just let's copy paste, except for EBIT, and because we want to build out a bull and bear case scenario. Okay. So equals the EBIT up until what we've recorded, 2025. We go to here, then let's just copy one of our boxes down. There we go. And let's say $41. EBIT margin, what should we say? Let's say it goes back to 35%. what's that, G14. Okay, but the bull is, so G14, and make sure now equals offset the cell that we're in, G77, C14, but remember to lock in the C and lock in the 14, another comma, 0, and then close brackets. There we go. Copy that across. Take the revenue, multiply it by the percentage of revenue to give us our EBIT, copy that across, and we're good to go to the next one. Taxes. Now we need to make the taxes so that when the EBIT changes, the taxes paid changes. So again, we copy up to 2025. We take the average, and then we do the EBIT multiplied by the, sorry, okay, let's just do that again. The cursor was in the way. We do the EBIT multiplied by the percentage, the tax rate, the percent of EBIT, the percentage of EBIT, and that helps us forecast. And when we play with the switch on the EBIT, it will adjust the taxes as well, appropriate to the percentage of EBIT, and that way it just gives us a, well, obviously because it's all linked to the cash flow, to calculating the cash flow, it keeps everything dynamic. Border, just do a line at the top. The next line we're going to calculate is the EBIT, which is the earnings before interest, but after tax. And we only need from 2026 onwards. And we take the EBIT, and we subtract the taxes. And this gives us our EBIT, which we just copy over. And now we take our depreciation and amortization, we take the CapEx and our change in net working capital. And we copy these down from where they are up here, copy across, copy across. We're almost there now, maybe 75%, 3/4 of the way through. Okay. Just take this, put another border there. Then we want the unlevered free cash flow. And how do we do this now? We go equals, we take the EBIT, we add back in depreciation and amortization because it's a non-cash expense. We then subtract the CapEx, we subtract the change in net working capital, and this gives us our unlevered free cash flow. And we pull it across to there. Now, the next thing we're going to do is we're going to work out the present value of the unlevered free cash flow. And how do we do this? We have to use our WACC that we built in the previous video. If you haven't done that, let's just, I'll show you what it is and what we calculated, 10.53%. Just put that into this box. So we go equals. If you've got it on your spreadsheet, make it dynamic, make it linked. If you're not, just type in 10.53%. For the bare case, we do the base plus 0.5%. No. Let me just put the column width back. And for the bull, we subtract 0.5%. The lower the WACC, the more bullish. And for terminal growth rate, I mean, Facebook is still a bit of a growth stock, but let's go with 2.5% anyway. And remember, if you are doing this and you think it should be something different, you can adjust it. But never make it more than GDP growth. Sorry. So now we have this filled. We need to make the switches dynamic. So instead of using the offset function, we're going to use one called choose, and we go on the WACC with a switch. We put a comma, and we just go through all of them. But you have to do it in the order that we have here. Just copy the format down, and then you can copy it and paste it down, and we get the terminal growth value there. Perfect. That's really, really good. Now, above this line, just add another row and put a 1 here. Then on the next column, do the previous +1 and copy it across until you get 5 by 2030. So you can either type it in, but let's be a bit more sophisticated and do it like this. The way we calculate the present value of unlevered free cash flow is we go equals, we take the unlevered free cash flow, we divide it by 1 plus the WACC, which we lock in, close brackets, to the power of the year. There we go. Yeah, can you see that? Then we just pull it across, and there we have it. So what's the next bit? Terminal value. And the terminal value is we take the final amount of free cash flow, we multiply it by 1 plus the WACC, close brackets, and then we divide by the WACC minus the terminal growth value. We close that. Yeah. Okay, now we want to find the present value, PV of the terminal value. So PV of TV equals divided by 1 plus the WACC to the power of the final year, which is 5. There we go. And after that, it's the enterprise value. And this is the sum of the present value of all the cash flows that it's going to generate. So that includes the present value of the terminal value plus all of these present value of cash flows forecasted. So 475 billion. Then what's the next? Then we add cash and we subtract debt. And this will give us our equity value. And so the cash, we're going to go onto the balance sheet. That's up here. Here we are, cash. Wow, look at that. It had 44 billion in cash in 24. Now it's only got 12. Ooh. And I wonder what the debt is now. Okay, oh no, we know what the debt is. We've done it on the WACC. There we go. So you take the enterprise value, you add the cash, and you subtract the debt. And there you have your equity value. Now, diluted shares outstanding. Let's just call it diluted SO. No, sorry. And then we'll get our implied share. Make this slightly bigger. We can move these in a bit closer to it. So it's like that. I'll zoom in. There we go. Okay. So the diluted shares outstanding are on the income statement here. 2580. 2580. Yeah, is that, yeah, you can all see that. Now, the implied share price, you just go equity value divided by the diluted shares outstanding, 178. Wow, okay. Well, that's a long way away from where the, sorry, 1 second, K108. Yeah, I mean, that would suggest there's quite a big downside. But okay, let's. Yeah. I mean, I don't even want to know what the low is going to be if it's, well, 130. So I wonder if we're being too conservative on the. Let's say advertising stays at, no, leave it at 50, but let's put other and reality to 20%. Yeah, it doesn't really move the needle. I mean, it's still around the same. It's not like it. I mean, the you'd okay. Maybe we can put the EBIT margin up to 40%, 250. So still, it's still 65 or 66% downside. It's yeah. Okay, but there we have it. There we've built out for Meta, and again, as more news comes out, let's keep updating them and trying to, well, get more information to help us forecast how the stock is going to perform. But yeah, okay, cool. Yeah, I'll see you on the next one, and yeah, thank you again for watching. And if you have any stocks that you would like me to go over, just drop them in the comments. And also, please subscribe to the channel. That really helps. And yeah, thank you very much.